Welcome to Money Manager. Speaking to us from Old Mutual's offices in Pinelands is Graham Tucker, Portfolio Manager, and tonight we are talking about the Old Mutual Balance Fund. Graham, thanks very much for joining us this evening. When I see Old Mutual Balance Fund, I think lots of money, big caps, slightly conservative but with a growth bias. Am I right?
Well, I think if you look at the fund, it's at 15.5 billion rand. That's the size of it. And I think by industry standards, that's not particularly large. Some of our competitors are running with much larger funds under management. So we actually see it as that we're in a bit of a size sweet spot. We're not really constrained in terms of where we can go. In terms of the equity universe, we're looking at the top 100 shares, give or take. That's an area where we think we can get reasonable size in the fund.
So you're almost at a critical mass, if you like, or not a critical mass, but 15.5 billion is manageable. You're not going to have to take a 20% stake in a company in order to make a difference. But on the other hand, you're big enough to make a meaningful stake in something.
Precisely, and we're big enough that we can afford the best research, top analysts. We have access to all the important functions that lie behind or in the background of these funds, such as a strong compliance team, a legal department, and so on. These are well-resourced areas within Old Mutual. So we're big enough that we can afford those resources, but we're not constrained when it comes to investing our clients' money.
It's an interesting fund composition you've got here, and I hope you don't mind. I'm going to go through the list because there's some that really stand out. SA Equities, 37.5%. I would say that is relatively low. SA Property, 3.7%, also maybe on the low side. Commodities, negligible, 0.9%. Convertible bonds, 1.2%. Nominal bonds, 14.6%, I think it says here. International equities, right up to the limit, close to 25%. That's understandable. International bonds, nothing, 0.5%. SA Cash, 17%. Let's start with that if we can. SA Cash, 17%. Historically, is that quite high for you?
Well, I think it is. If you look at what we've been doing over the last few months, as equities have been running up and becoming more and more expensive, we've seen that the future return, or our expectation of the future return, diminish. So when we look at our 5-year expected real return forecasts, those have been coming in slowly but surely over the last few years as we've seen markets run quite hard. And so we've been using opportunities to reduce our exposure to the local equities, realizing that the risk to the equities, given their high valuations and the earnings outlook, we feel that the risk has increased, and so we feel it's prudent to take money off the table and put that into cash, which is a safer asset for the meantime, or in the meantime. And really, we don't want to be holding cash in the long term, because cash does not deliver the real return that our clients require. But in the short term, it is a safe asset, and given the increasing risks, as I mentioned, we think it's prudent to build up some cash in the portfolio, and that allows us to buy back into the market when we see a significant enough correction.
We'll talk about that in a moment. So when the rand goes from 12 to 13 and 13 for 14, and your international exposure goes from 25% up to 27.5%, you have to liquidate some assets to bring it back into the country. That also goes into the cash, is that right?
That's correct. But in terms of the regulations around our fund, we have a 12-month grace period in terms of repatriating those assets. So we can sit with that exposure above 25% for up to 12 months and really benefits from our preferred asset class, which is global equity. So we see that as the most appealing asset class on a risk-adjusted basis going forward, and not because of the rand. The rand is a bonus, if you will. It's really the growth story that we see better growth coming out of developed markets than we do out of emerging markets and out of South Africa. So ideally, where we are positioning our funds is towards developed market equities. And you're seeing that coming through in our local equity exposure as well. So we have a large weight to counters such as Steinhoff, Investec, Mondi, all companies that have a significant global footprint. So that's a way of increasing our exposure to those global companies So when you look at our portfolio today, we've got 25% directly invested offshore. But when you take into consideration all of those other counters, we're actually sitting somewhere between 45 and 50% in global assets.
Indeed, we'll come to Steinhoff in a moment, because after a 4% move yesterday, we've got another fairly decent move after those results came out. SA equities 37.5%. Is that quite low, again, historically speaking?
I think that is quite low, and I think you're seeing that across the board. So if you look at the history of how the regulations have changed, we've been, as fund managers, we're allowed to take more and more of our clients' exposure offshore over the last 10, 15 years. And what you're seeing is managers utilizing that capability or that capacity. And as I said, it's our preferred area for our assets, for our clients' investments. We like the look of the global equity space, and so for us it makes sense to have as much as we can in global equity, which means that we're in the process of reducing the South African equity. So our view is not that we should be running with the maximum amount in equity that's allowed. There is risk to the local equity components of the fund. And so we have been bringing that back. So some of the counters that we've held in the past and we've sold, we bought Foschini Group, we bought Telkom, and those performed very well for our clients. But as those ran up and as the environment for them deteriorated, in our view, we've sold out of those counters. If I look back a year ago, we were quite big sellers of resources. So we have no platinum, no gold exposure, no iron ore exposure through the direct miners in the portfolio.
It's quite interesting, actually, because I mean we could go into a lot of the things that you just said in greater detail, but just a quick comment, because Sibanye and Anglo American Platinum have got together, come to an agreement this week, and that's interesting. And also with the Glencore story, one of the things that could be said is that this might be a game changer this week for the resources index of the JSE and for resources prices worldwide. Production cuts, consolidation in the industry, and maybe people will take a fresh look at this sector suddenly.
Yes, it's something that we're looking at quite hard. So when we look back at what's happened over the last 50, 60 years, and you look specifically at commodity prices, what you've seen is commodity prices had a fantastic run in the mid-2000s off the back of China. And when we look at the commodity prices that are relevant to South African companies, what we see is that those prices rose more than 350% due to that China impact. However, what we've seen more recently is that those prices have come off as there's been a lot of concern around China. And so a lot of those commodity prices have now fallen 50%. And so they start to look more attractive. But the reality is that they're still up significantly on their pre-China levels. So when we're looking at it, we're saying, yes, it's hard to argue that, that the commodity prices themselves have fallen, and that there might be some value returning there. But in our view, it's hard to argue that they're cheap at the moment, particularly when we look at the supply issues. So there's a lot of supply coming online. Chinese demand is waning, and so that's going to put pressure on commodity prices, and we need to see something change in the industry. So if we're looking for production cuts, and that would be a positive signal for us, but it's really around the extent. So I think you've seen a lot of the miners cutting back on their future capital expenditure, and they're starting to trim back on their production, and we're looking for more and more signs of that before we start investing our clients' money back into that area of the market.
Quickly overseas, I don't need you to go through your foreign equity portfolio, but just tell me the type of company that you favour.
So our preference at the moment is really around Europe and Japan, because that's where we see the most value, but also that there's the biggest change coming through. So in terms of the growth prospects, if you look at Europe, they were growing at -1% GDP. They're now expected to grow between 1 and 1.5. It's not fantastic growth, but it's much better growth. It's a much better picture. So it's that change in the growth that's really important. And as I said, attractive valuations. So off the back of those factors, we like the idea of Europe and Japan, and have overweighted our clients' funds to those two countries. The US is also quite interesting, but has run hard. And so given that the valuations there are more expensive, we've pulled back on our exposure to the States. And then again, when you turn to emerging markets, we've adopted an underweight position in emerging markets, again, off the back of the change. So China was growing at 10%, it's growing at 7%, according to the numbers that we've seen recently. But the reality is that they're probably growing closer to 4 to 5. And I think that's what the world's waking up to. So again, looking at the change is quite important for us.
Just having a look at your top 10, we haven't got much time left, and I just want you to pick one stock which sort of characterises your investment philosophy and the type of company, again, that you favour. Okay, number one, it's Naspers, and then you go in-house to Nedbank Group and also Old Mutual itself, Steinhoff, Standard Bank, Investec PLC, British American Tobacco, MTN, Sasol, Mondi, all big names, all great companies, all have done pretty well, thank you very much. Which of those would you single out to say this sort of epitomises the Old Mutual Balance Fund?
Well, I think one of the big themes that we've got running through our portfolio is the theme around dividend yield. And I think Nedbank falls into that one quite nicely, but actually all of the banks do. So when you look at your source of return, it really comes from one of three places. Or there are three possible sources of that return. Yeah. It's the valuation, it's the earnings growth, and then it's the dividend yield. So when we're looking at valuations, companies have run very hard over the last 5 years. And so that's unlikely to be your primary driver of returns going forward. Then let's turn our attention to earnings growth. I think companies are struggling. And so trying to deliver earnings growth or actually being able to deliver earnings growth is going to be difficult going forward. So we're not seeing that as a big driver, but where we can find it, we are positioning our portfolios for that. But the real source of return going forward, in our view, is around dividend yield. And it's those companies that are able to pay a safe and growing dividend yield. So let's look at something like Vodacom. Vodacom pays an attractive dividend yield. It generates a lot of cash. It's not the most exciting company in the world, but it should be growing its earnings at roughly 8, 9, maybe even 10% over the next year or so, and that is attractive in this environment. So it's got a very attractive dividend yield, and it's a fairly stable dividend yield, and it's a growing dividend yield. And I think that's the way we've been tilting our portfolio over the last while, is towards companies where we have some certainty of return.
It's a very neat way to end the conversation. Thanks very much for your time this evening, Graham. That's Graham Tucker from Old Mutual talking about the Old Mutual Balance Fund, and that's it for Money Manager.